Okay, so Wall Street just had a really rough Monday, like open your eyes and everything is already on fire kind of morning. The Dow just finished its fourth week in a row going down, which hasn't happened in 3 whole years. The S&P 500 basically wiped out everything it gained in the last 6 months. Gone. Over in Asia, markets are practically falling off a cliff, with South Korea dropping 6.5% in just one day. And the people who run America's money, the Federal Reserve, just quietly admitted they might actually raise interest rates instead of lowering them before the year is even over. Now, this isn't financial advice, but when you know how to read data and spot patterns, what's going on right now becomes pretty obvious pretty fast. The US economy is sliding into something called stagflation, and the thing is, the forces pushing it there are actually speeding up, not slowing down. I'm Ella Houseville on YouTube. I have a PhD in computer science, and I use data analysis to find hidden patterns in geopolitics and economics. When we look closely at the market numbers from the past week and today, we're watching a very specific kind of collapse pattern, the kind that separates a bad but fixable shock from a full on system breakdown. Friday's closing numbers alone tell half the story. The Dow dropped 444 points, which is about 0.96% down. The S&P 500 fell 1.51% and closed at 6,056, its lowest point since September. The Nasdaq had it even worse, crashing 2.01% and closing at 21,647. Both the Dow and the Nasdaq actually touched correction territory during the day, meaning they had fallen more than 10% from their recent high points, before crawling back just a little by closing time. Then, before Monday even officially opened, U.S. stock futures were already sinking. Dow futures were down 0.6%, S&P 500 futures down 0.8%, and Nasdaq futures leading the drop at 0.9%. Asian markets had already collapsed hours before all of this. South Korea's Kospi plunged 6.5%. Japan's Nikkei 225 fell 3.5%. Hong Kong's Hang Seng tumbled 4%. What set it all off was a Saturday night ultimatum from Trump. He gave Iran 48 hours to reopen the Strait of Hormuz or face attacks on its power plants. There's a separate video breaking that down. Go check it out next. Iran fired back by threatening to shut the strait completely and keep it closed until every bit of destroyed infrastructure gets rebuilt. Meanwhile, Brent crude oil jumped above $113 per barrel on Monday, which is more than 50% higher than when the war first started. But here's the thing most people completely miss when they're just reading the big headlines. The Dow's 4-week losing streak and the S&P 500's 4 straight weeks of declines. Those aren't just numbers that feel bad emotionally. If you pull the Federal Reserve's latest projections and lay them right next to market pricing data, the actual machine driving all of this becomes really clear. Last Wednesday, the Federal Reserve kept interest rates where they were, which everyone expected. But then Fed officials put out updated economic projections, and those projections now show they expect inflation to be at 2.7% for 2026, which is higher than what they predicted before. They still wrote down the possibility of one rate cut this year, but the fine print tells a completely different story. Fed Chair Jerome Powell stood in front of reporters and basically said nobody has any idea what's coming. He said the economic effects could be bigger, they could be smaller, they could be much smaller, they could be much bigger. That kind of answer from the person running America's money, that uncertainty right there is the entire problem. Before the Iran war started, markets had fully expected 2 interest rate cuts in 2026. Then, after Wednesday's Fed meeting, futures markets showed something wild. Not only were people giving up on rate cuts, but the odds that the Fed would actually raise rates before the year ends hit 50%. What's happening underneath all of this is a stagflationary shock. Fed Governor Christopher Waller said he had actually planned to push for a rate cut at Wednesday's meeting, but the Iran war completely changed his thinking. He came out and said this is looking like it's going to be a much more drawn-out conflict and oil prices are going to stay high for a longer time, which means inflation is the bigger worry right now. Waller was actually put on the Fed by Trump back in 2020, so his statement goes directly against what the administration has been saying publicly. Goldman Sachs also raised its oil price targets on Monday. The bank now expects Brent crude to trade at $110 per barrel through March and April, up from their earlier forecast of $98. And that's assuming the Strait of Hormuz flows stay at just 5% of normal levels for about a 6-week stretch. For all of 2026, Goldman now forecasts Brent averaging $85 per barrel and WTI at $79, both higher than their previous estimates of $77 and $72. If you want to get better at reading what headlines are actually hiding versus what they say out loud, there's a book called Awake: The Practice of Critical Thinking in an Age of Self-Lies. It walks through the exact frameworks for reading between the lines of official statements and connecting policy moves to what actually happens in markets. It's available as an ebook and audiobook. Subscribers get 10% off, and the first chapter is free through the links in the description. When you line up the Fed's inflation projections right next to Treasury yield movements, the chain reaction becomes really easy to see. The 10-year Treasury yield jumped to 4.38% on Friday, up from 4.25% on Thursday, and from just 3.97% before the war even began. The 2-year Treasury yield, which tracks what people expect the Fed to do, rose to 3.88% from 3.79%. When bond yields go up like that, investors start moving their money out of stocks. Mortgage rates spiked to 6.53%. That's a full half-point increase in just 3 weeks. And this is happening right as spring home buying season is starting. Gas prices hit $3.94 per gallon nationally, up almost a full dollar in a single month, with California crossing $5. On Friday, Iraq declared force majeure on all foreign-operated oil fields. 2 refineries in Kuwait were struck by drones on Thursday. And all of this triggers a chain reaction. People start spending less because so much of their money is going to gas. Companies start making less profit because their costs are rising. The job market eventually starts to weaken too. But inflation keeps going up because energy costs bleed into literally every single industry. The Fed is stuck in the classic stagflation trap. They can't cut rates to help the economy because inflation is too high, but the economy is getting weaker anyway. From working with economic systems, it's clear that stagflation scenarios create winners, and those winners are whoever holds alternatives to the reserve currency. Europe and Canada are already positioning themselves to benefit from exactly this kind of moment. There's a whole video on how they're challenging US dollar dominance. Go watch that one to understand why dollar instability during an energy crisis speeds that process up. Asia is taking the hardest and most immediate hit of anyone right now. Japan's Nikkei 225 and South Korea's Kospi have both fallen roughly 12% since the war began. Japan gets 75% of its oil imports from the Middle East. South Korea gets 75% from the exact same region. Both countries only have limited reserves of LNG, enough to cover maybe 2 to 4 weeks of normal demand. The small cap Russell 2000 index has already fallen into correction territory, down more than 10% from its recent high. Even gold, which people usually run to when the world feels scary, dropped 2% on Friday and posted its single worst week since 1983, down more than 10%. 4 out of every 5 S&P 500 stocks fell on Friday, which tells you this isn't just a few companies having a bad day. The selling is happening everywhere at once. History does give us a kind of playbook for this. Analysts looked at 40 major geopolitical events over 85 years, and on average, the S&P 500 loses about 0.9% in the first month, but then gains 3 to 4% over the following 6 months. But here's the key difference. The 1970s Arab oil embargo pulled 4 million barrels per day off the market, which was about 7% of global consumption. A full closure of the Strait of Hormuz removes 20 million barrels per day. That's 20% of everything the entire world uses. There are 3 specific signals worth watching closely from here. First, whether Trump actually follows through on his power plant threat. Second, whether the Fed's April dot plot shows more officials writing in rate hikes. Third, whether mortgage application numbers collapse when March data comes out in the U.S. If oil stays above $110 through April and the Fed signals rate increases are coming, the S&P 500 will likely test 6,200, another roughly 5% drop from here. And that would set off automatic selling from algorithmic trading systems while consumer spending visibly contracts in the second quarter of this year. Europe and Canada, both less dependent on Middle East oil and holding more diversified reserve portfolios, would likely see capital flowing in as investors look for stability outside dollar-denominated assets. And again, none of this is financial advice. Please don't go changing any positions based on these videos. Stagflation ultimately benefits the currencies, challenging the dollar's reserve status. When the Fed can't cut rates because inflation is too hot, but the economy is still weakening, dollar assets become less attractive. And that's the exact mechanism through which energy shocks speed up currency realignment around the world. For the full context on how Trump's original ultimatum created this entire situation, go watch the video on your screen right now. Thank you all so much for watching. Subscribe, and I'll see you all in the next one.